This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Neeson, this is question 4 from the December 2010 P7 examination. As always, we'll go to the requirements to see what's there. And the part A one here, evaluate each of the suggestions made above, commenting on the ethical and professional issues raised. So remember to do both of those, ethical and professional issues raised. And B, I've set up an internal discussion board, explain the ethical threats created by long association with an audit client, and evaluate the advantages and disadvantages of compulsory audit firm rotation. So let's look at the first one here. Manager in Neeson, a firm of chartered certified accountants, 3 offices, 12 partners. It's a moderate to small, really. About 1/3 of the firm's clients are audit clients. The remainder are clients for whom Neeson performs tax, accounting and business advisory services. Now, why have we been told that? Is it relevant? It's slightly unusual maybe to be told the kind of client makeup, if you like, within a firm. The examiner has obviously taken some care here. 1/3 of the firm's clients are audit, and the rest are these non-audit clients where they're doing other sorts of work. The firm is considering how to generate more revenue, and it's got a couple of suggestions coming through here. First is that an ad could be placed in national papers to attract new clients, and the draft ad has been given to you for review. So first of all, Neeson, it says, is the largest and most professional accountancy and audit provider in the country. Well, maybe it is if it was a very small country, but if we have 3 offices and 12 partners, it doesn't really convince one that it maybe is the largest firm in the country. Unless there are kind of auditors in the Vatican or something like that, where it's maybe the only firm which is around. And of course, what you're not allowed to say in adverts is to make any sort of misleading or claims which are untrue. You mustn't make any promises that you can't hold. You mustn't mislead people into what they're getting for their money or the kind of services that you're going to be able to provide. By all means, advertise what you can do fairly, but keep it legal and keep it truthful. So that's the first thing I think we could think about. Is that true? Most professional accountancy. So this is bad, because it's kind of denigrating the opposition. It's saying I'm the most professional, but they're actually a bit dodgy. Really, they're kind of only half professional. So it's really getting into this kind of professional behaviour. Really, by all means, say that you're professional and technically able, if that's indeed true, but you can't say you are the best or anything of that type. We offer a range of services in addition to audit, which are guaranteed to improve your business efficiency and save you tax. But guaranteed to improve business efficiency and save you tax. Well, how do we know? If you think about the tax, this is saying I'm going to guarantee to save you tax. And again, it kind of raises little questions. Are you saving them tax by, doing the tax incorrectly, fiddling the tax, something of that sort? And certainly they couldn't live up to this guarantee, which is here at all. They might be very efficient, their tax might be absolutely minimized already. if you're unhappy with your auditors, we can offer a second opinion on the report that has been given. So again, it's not really professional behaviour to sow these seeds of doubt here between a client and their auditors. And this here, offering a second opinion, is wrong. Clients, of course, can go and decide that they want a second opinion if they disagree with some contentious element of what their current auditors are asking them to do. But it is not up to third-party auditors to come and say, if you don't like their opinion, I'll give you a different one. You know, it's like saying, I have my principles. If you don't like those, I have others. So to this kind of a opinion touting, so to speak, is absolutely not right. It raises a spectre of a firm going round from auditor to auditor to auditor to auditor until they find one that lets them get away with what they want to be getting away with. And certainly auditors shouldn't encourage that. We have an introductory offer for all clients. We offer a 25% discount. Now what we have to be careful of is really lowballing. 25% is a heck of a lot of the fee. We know that fees can be competitive. That's very often how you get new clients. But you have to be able to be seen to be able to do a decent audit for that fee. That you are not depending on kind of cross-subsidization from your tax work or your advisory services, anything of that type. We also have to be careful here. It doesn't say that it is a listed company, but nevertheless we have to think, if we're going in and we begin to offer these other accountancy services, we just have to bear in mind that we mustn't be getting more than a reasonable amount of fee from any one client. Number 2, a new partner with experience in the banking sector has joined Neeson. It's been suggested that the partner could specialise in offering corporate finance services to clients. Okay? Particularly, the partner could advise clients on raising debt finance and would negotiate with the client's bank or other providers of finance. The fee charged for the service would be contingent on the client obtaining the finance with a borrowing cost below that of the market rate. What we should be particularly concerned about here is, again, this is other work, but quite often corporate finance is a very lucrative business, and we have to worry about a kind of self-interest threat here. We're doing the audit, and then we bring in this new partner who gets lots more fees coming from the client, and it could push us over, a reasonable limit of the amount of fees you get from any one client. Now this, I think, is maybe where we come back relevant here, that only a third of the firm's clients are audit clients. And we're not going to have the same problem, if you like, the same ethical difficulty if we're not actually doing an audit for a client. If we're not actually doing an audit for the client, some of the ethical considerations are altered a little bit. And we don't have to maybe maintain quite the same degree of independence if we're helping him to do tax and helping him to do accountancy and helping him to raise the corporate finance. We're not going to give, we're not in any danger of giving a soft, easy audit report because we want to hang on to the other money, the other fee income. We also, I think, need to worry here just a little bit. Would negotiate with the client's bank on behalf of the client. So we're getting quite close here to advocacy. And even though we might be negotiating on behalf of clients who are not audit clients, nevertheless, if we push what we're saying beyond what is reasonable, and we're saying to the banks, yes, lend money, these people are really reliable, they've got a great future ahead of them, and in fact that is not borne out by the facts, then it undermines the whole ethical stance of the firm. Firms of certified accountants have to be independent, objective, and so on. They must base what they're saying on facts as far as they can, and not kind of exaggerate because it's simply not being objective. And finally, we need to worry a little bit about the contingent fees. Contingent fees are by and large frowned upon. Certainly it will maybe encourage this person, this corporate finance person, to get the big fees, to maybe push harder than they should, maybe by exaggerating the future prospects of the client in order to get the low cost borrowing rate. Finally, we might be able to also raise an issue here on this new partner. The person has banking experience, but banking is quite a broad industry. Doesn't mean that even though they've come from a bank, they actually have experience in corporate finance, or was their experience more in operating individual people's current accounts? Were they more of a consumer bank manager, or were they a kind of corporate finance bank manager? And we could also raise something here about the professional competence of this person. 4b is pretty straightforward. Explain the ethical threats created by a long association with an audit client. And broadly speaking, there's self-interest. You don't want to fall out with an audit. You're probably friends to some extent with this audit client. The other self-interest kind of threat can arise that if you have given them a clean bill of health last year, then it might be difficult for you to have a modified opinion this year. If that's kind of saying, well, last year's opinion was wrong, you're kind of admitting we should have spotted this last year, and there's a self-interest threat in covering it up for both years. There is, of course, a familiarity threat. We get to know this client very well and the personnel involved with it. And once you have this familiarity threat growing, then it's very hard to maintain the professional skepticism at the level to which it should really be maintained. So we have self-interest threats. We might even get self-review threats. You might even get intimidation threats. Intimidation threats because this company can say to you, well, last year you said this, now you're saying something different. How come? Are you telling me that last year we were wrong, and can I sue you for that because we had this wrong advice last year? So what we think, of course, is that we have to shift people on, and 2 looks at the advantages, disadvantages of compulsory audit firm rotation. It's not there yet, but of course what we have is compulsory audit partner rotation, that after 7 years for listed companies, the engagement partner has to be moved on, and you get a new engagement partner with a new set of eyes, and not hampered by familiarity threats and self-interest threats and so on. And now, certainly in the UK, the audit appointment has to be put out for tender every 10 years. You might go back to the same people. Now, none of that is well, slightly saying advantages and disadvantages. The advantage of the rotation is a fresh set of eyes on it. You're going to have people coming in who have got their professional skepticism undimmed. You will not have a familiarity threat. You will not have a self-interest threat, and so on. Those are all the good things. Disadvantages. Disadvantages are mainly going to be kind of cost disadvantage, that the current auditors have got a really good deep knowledge of your company. They've got all the documentation set up of your internal control system. And if you have a new set of auditors coming in, they have to spend a long time documenting and evaluating your internal control system, getting to understand where the major risks and so on are. So there's an initial large kind of get up cost until they have done all of this kind of initial documentation and getting to know your risk areas and also to some extent getting to really understand the business. And you could see that the client could become a little bit irritated. This new set of auditors comes in and kind of asks the same old questions all over again, that if only they'd kept their old auditors, they wouldn't have to bother answering.